S&P's been on a roller coaster. Your 401k took a hit, and inflation is still eating your savings alive. Meanwhile, there's a boring old asset class, quietly paying 4 to 6% a year, tax-free, with a guaranteed floor and no market risk at all. And last quarter, 18% more Americans moved their money into it. We're going to be talking about that asset class today. Last week, we talked about what you need to know about TEFRA and DEFRA, because this is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
All right, the asset class that we're talking about, whole life insurance. A lot of people are picking this up. In fact, I think whole life policy counts hit a 35-year high. I would say that's a flight to guarantees.
Yeah, I think one of the things that's really driving that is this combination of those 4 to 6% secure returns that you were talking about. And there's a lot of people talking about the ability to tap that liquidity and use it as a line of credit for the infinite banking concept or whatever it might be. And having that, high or good return, that solid, safe return that is not interrupted by market crashes is a really powerful thing that I think a lot of people, especially in today's kind of uncertain times, there's good reason for why people are going to whole life.
Yeah, they say 49% of retirement savers worry most about inflation and 33% about interest rates, which kind of makes sense. I think we have more retirees now than we've ever had in the history of our country. And inflation is going to be a big factor in what's going to happen to their money, the value of their money. And people that are thinking about retirement or getting close to retirement have to think about having that money protected. We've had some really good years in the stock market lately. And so likely they've got really good performing 401ks, but they're starting to feel uncomfortable because everything is so high and everything's been moving up and down so much over the last couple of years. The volatility is just, it's an emotional roller coaster if you pay attention to the stock market.
Yeah, and one thing to touch on connected to what you said in the beginning of the episode with the tax-free, well, the way that whole life and life insurance can become tax-free is you use post-tax dollars in paying into this, and you can use this for retirement. So it can become that tax-free retirement asset class that is really secure, that you can tap by accessing through policy loans or withdrawing up to your tax basis or the amount of premiums that you've paid in. So this is a really good thing when supplementing for your retirement. You might not have this be your sole only asset class that you're contributing to. It can be a really good thing to supplement. Maybe you're maxing out your 401k or your IRA already. So having whole life where you can have that liquidity in the short term, but also have something that can be tapped when market corrections happen. Whole life is a really, really good asset for that.
Yeah, we're definitely not talking about it as a replacement to a 401k. Each one of these financial tools has its place. We like to see it as a complement to the 401k. In fact, I think we recently did an episode where we talked about cash value life insurance being that volatility buffer that helps to extend whatever income you're trying to draw from all of your assets in retirement, and how it does a better job when combined with other investments that might have much better returns, but don't have those guarantees, that don't have that downside protection or are not correlated to the growth in the stock market.
Yeah, and I think one thing to keep in mind, if you're talking to agents who say don't ever touch a 401k or whatever other retirement accounts, IRAs, and they're just not really giving you good reasons for it. They're saying, hey, just put it all into whole life. I think you got to be careful, take a step back, maybe have a conversation with somebody else, because I think a 401k can be a really powerful tool. Roth accounts can be really powerful tools for people to grow wealth. And whole life or even IUL, these are fantastic tools that can be used in conjunction with those, especially if you're getting into those contribution limits, or if you have this thought in your head, maybe I'm going to need to tap that cash at some point. You don't want to run into a situation where you have to pay penalties. Another thing is this consideration around RMDs, or required minimum distributions. So there can be circumstances if you got too much in your 401k, really at a certain age, post retirement. I think it's 70, 72 now, I believe, is where that kicks in. You are required to start taking money out. And so that can also have tax implications. So all of these different factors, whole life can be a good supplement in these different scenarios.
All right, before we get too far into this episode, we got to address the elephant in the room and the reason people probably clicked on this. Because in the title, we said that this boring asset class might be outperforming your 401k. But we know, because we pay attention to the stock market, it has been some really good years over the last 5 to 10 and 15 years in the stock market. So people might be clicking on this being very, very skeptical. So what do we mean by this boring asset class could be outperforming a 401k?
Well, the main reason is human behavior and the way that we think, and even, people who've been investing or trading in the markets, I have my own stories of selling at the wrong time. We get cold feet sometimes, and that just naturally happens. And it happened to a lot of people with the flash crash and then this giant run up. So there is this scenario where people probably exited in that crash, and then they're buying back into the peak. There's a lot of people who did that sort of thing and that's what would have caused that run up. So it just naturally will happen to people, that people get nerves in these sort of scenarios and move funds out of the market.
Yeah, you can point to the actual average returns in the stock market or even how it's been doing over the last 5, 10, and 15 years and just think that everybody must have done really well in it. But the challenge is that people are people. And if they're actually paying attention to the market, we tend to get nervous when volatility is causing prices to go up and down and inflation is high and we have a massive pandemic that could be causing crashes. And the reality is a lot of people can't stomach that. And they end up buying high and selling low and just getting out and not being able to take advantage of all of those gains that you see. That doesn't mean that there's not a decent number of people who have made a significant amount of money. The people that tend to make the most money in their 401ks are the people that kind of forget about it. They don't pay attention and they just keep contributing. But for the people that do, that roller coaster is very real. I have a personal story. There's a family member that back in, I think it was 2019, they're very close to retirement. And they weren't retired yet. They still had a few more years to work, but significant amount of money in their retirement account. But they were really uncomfortable with everything that they were seeing going on in the country. And they were rightly concerned enough that they actually moved mostly into a money market account. And they didn't catch the run up that happened after the COVID drop and the run up that happened over the last few years. I think they ended up getting back in it a bit. But the reality is, and this really hit home when we see this, is that throughout the stages of people's lives, they're going to have to make real decisions about what they're seeing happening today and can they take the risk that it will come back like it always has in the past. That most financial managers will attempt to convince you of so that they can manage your money that, hey, just ride it out. It'll come back. But emotion-wise, that is the hardest thing to do.
What tends to happen in our heads is, this time it will be different. That's what we always think. And I think that's a natural instinct. As I mentioned, I've had some scenarios where I've exited positions where I could have profited 6 or 7 figures possibly off of some of these positions. And I got cold feet because I don't know, there's so many factors, and it's just what happens naturally. And, you know, this is a scenario where the the lost decade is something that we've talked about a couple of times. In the year 2000 to around 2010, people who had invested money in 2000 and didn't do anything with it and didn't touch it, they would have been about even in 2010 or so. So there's this interesting time. There's different times where something like whole life could definitely outperform the market in general, but also in any given person's portfolio. If you have it in your toolkit, it can help you sleep better at night because you might not worry about moving those 401k funds at the wrong time.
Yeah, I call that, what's your sleep number? What diversification into uncorrelated assets or safe growth places where we don't have to worry about it? What's the right diversification that allows you to sleep better at night? That's your sleep number. That's what we need to be thinking about setting aside. If you have everything in the stock market and it comes down 30%, are you going to be able to sleep at night, or are you going to be up worrying? Because that can cause all kinds of problem in your life. But if you planned ahead and you have some of your savings in a good bond alternative like whole life, well, in 2022, bonds and stocks both crashed 30%. So if you had a traditional bond stock portfolio, that whole thing crashed. You would have been really nervous, especially if you're getting close to retirement. But for people that had that diversification into whole life, they didn't have to worry about it. They were able to sleep at night. And that's really where we can see some outperformance here. If you get 30, 40, 50 years of tax-deferred compounding growth of around 5%, that actually adds up to quite a bit of money, especially compared to people who otherwise can't stomach the movements of the stock market very well, because they're going to do everything wrong when it comes to being a good investor in the stock market.
I consider myself kind of mid-career. Um, I've got a lot more working years. So even I, in mid-career, I can make these wrong decisions, but I know that as I build up my portfolio and my whole life and my IUL, and I get to retirement, I'm going to have a good amount of cash in there that gives me that peace of mind that whatever happens with the market, like my goal is to actually potentially be able to live off of my whole life and IUL for a very long time in order to weather whatever market storm could happen and use these different assets to weather those market storms. So that's one thing that, it's a good idea if even if, especially if you're young, to really start building that now in order to get to retirement and be like, well, whatever happens, happens. And it's not a huge deal.
Yeah, and so I think the answer to the question is more of a, when can this boring asset class outperform the 401k? Not that it will always outperform it, but in a volatile market, it does a much better job of getting people to kind of hang on, let it play out, let your other things do what they're doing, knowing that you've got this safe nest egg that's not going to be impacted. And that's really what we're here to talk about, and why we like this asset class so much is because what it allows us to do outside of it and the safety and comfort it brings us, especially in the case of an early tragedy. If something happens to one of us unexpectedly while we're young and healthy, and we don't expect to actually pass away, but if we're the breadwinner of the household and we bring in hundreds of thousands of dollars a year, over the next 20 years, that's millions of dollars of income that will no longer be coming into this family if we pass away. But the beauty of life insurance is that it can help replace that income. And that's really the backbone of it. And with a proper design, we're also getting liquidity and growth inside of it, access to the money that we're putting into it, and the other benefits just come along with it. And I just can't talk about it enough. I get so excited every time I look at my policies and I have the ability to fund them each year. It's just something that I've always felt really good about. And we can definitely put a price tag on it, but it's what comes to mind is the phrase, it's hard to put a price tag on something like that. But there is a definite cost to it. And the way we design these things, it's as minimal as possible.
Well, and another thing, though, and it is as minimal as possible in terms of our cost, but when you're thinking about life insurance purely as a liability, then it is just a cost. But I didn't have what I would view as enough life insurance to cover that loss of income on myself for my family until I started turning life insurance into an asset. And so now I have significantly more life insurance than I ever had. And I think that's a smart thing, just in case, things don't go well. And certainly, as you mentioned, if I do pass away early, hopefully not, it will be a much better return than any market investment that I could make.
Yeah, and that's actually the exact situation I was in as well. I had basically no life insurance. There were a few years that I had some life insurance, but I didn't value it at all. I was young, I'm strong, I was healthy. I had no thoughts about the risk that it represented of me passing away and what that could do to my family. I wasn't thinking about generational wealth, not to mention the current generation and the impact it would have on them. But it turns out when we design policies the way that we do, the attractiveness of being able to just shovel extra money that way, what it does is effectively gives us a very large death benefit that's almost little to no cost. And in that scenario, it becomes easy to fund it. It's an easy asset to own because of what it provides outside of that death benefit.
Yeah, and I think in the end, that's really what we're talking about here and why this is an asset class. It's boring, but for the right circumstances and the right times, it can certainly outperform the 401k, and it even can help you stabilize that 401k and not touch it at those wrong times. So your 401k could do better as a product of having this because you're doing the right things and keeping your assets secure with something like a whole life policy to supplement that 401k.
All right, wrapping this up. In a volatile market, whole life insurance could outperform a 401k. Next week, Dave Ramsey loves to say that the insurance companies just keep your cash value and they only pay out your death benefit. Well, we're going to address what really happens to your cash value when you die. Be sure to join us for that. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.